Welcome back to DukascopyTV. For decades, oil products have been the basis for pricing long-term gas contracts, but some experts say this link is soon to be a thing of the past. Joining me to discuss this subject in more detail is Alejandro Navarro Paustian. Alejandro, thank you very much for coming in today.
Thanks very much for having me.
No problem at all. Now, could you tell me who are the main counterparties in these long-term contracts, please?
While we see, for example, in the power sector as well as the renewable sector, or even to an extent the LNG, you can basically put a power plant wherever you like, or in the renewable sector, you can put a wind farm, or let's say a hydro plant wherever you like, or an LNG regas facility. On the gas sector, we need to look at the supply country. Supply countries for the European Union would be, for example, Russia, which has over 40% of the European Union imports. You have Norway, which supplies over 20% of the imports to the European Union, as well as Algeria, which just supplies just under 20%. The main counterparties, the main countries, are mainly governmental and state-driven companies, such as Gazprom or Sonatrach or Statoil, which you can imagine the political as well as the economic consequences of dealing with these type of counterparties.
Okay, and what are the current trends that are occurring in these type of contracts, would you say?
The contracts, the current contracts are based on the Groningen model. This is a contract that was entered into in the 60s, and it was a kind of a long-term agreement, which would last from 15 to 30 years approximately. It was very much driven by the supplying countries that I mentioned previously, and they would be very much linked to the oil, because of we didn't have at that time such a spot market in the gas on the gas sector. Currently, we would look more of a things have changed. You would see that, for example, the transparency has changed. Now the amortization of the infrastructure has changed. Now you can much quicker amortize a project through these long-term contracts. And you would have, for example, like one agreement wouldn't be necessarily linked to one project. You could have like one pipeline and have different contracts that would serve that pipeline. The market players have changed as well. New resources like renewable energy or the LNG that comes from the US now, that doesn't import any more LNG. So the situation has changed, and therefore we see that these contracts are changing slowly as well, from on the market side, on the pricing side, more from perhaps oil-driven side to more market-driven type of pricing mechanism in these type of contracts.
Okay, you mentioned markets there. What type of effect do these long-term contracts have on the market?
The main issues that these contracts made is that at the end of the day, you have one handful of supplying countries, supplying companies, and a handful of purchasers. So therefore, you see that there's a barrier to entry there for new companies that want to enter this market. There are also positives in this. As you can imagine, the demanding countries, the European Union, would like some stability, and then obviously these long-term contracts provide the stability, and as well as a security of supply. It is definitely needed or a requirement for European Union to feel that they have the security of this country supplying the demands for the European Union. So like a lot of things in life, there's positives and negatives and effects of these contracts.
And you mentioned positives and negatives. What would you say are the main challenges affecting these contracts?
We have a lot of challenges nowadays, considering the European Union requires investment in infrastructure as well as the update of the current infrastructure. So it needs to find a balance in order to make the governments nowadays have a lack of funds in order to invest in this type of infrastructure, and therefore needs to look to the private sector for those to invest in this type of infrastructure. So how can you, if on the one hand you're looking for the liberalization of the market to make it accessible to any new company, new entrant that wants to get into this market, but on the other hand you make it you want to make an incentive for these private companies to invest and get profitability out of these investments. You need to find a balance.
So what do you think the future holds in store for these type of contracts then?
I think it's it's a difficult question in the sense of it will be difficult to get these major players to get out of these type of relationships, these type of agreements. I mean, you have to think that they want to secure a demand and these pay or take clauses that are currently in these type of relationships, in which they secure the buyer to buy this the gas. On the other hand, I think that there's enough pressure from the European Union in the sense of to have a more transparent and liquid market and aiming for the liberalization of the market. I think the future will tend to move from this oil-driven pricing to perhaps a more market-driven pricing, also considering the increasing volumes of the hubs that we have, such as TTF or MVP, and in addition to the alternative supplies of energy, such as the renewable energy or the LNG, or even different jurisdictions, such as the Caspian region, will provide a much more competitive market, which will lead, in my view, to a more competitive and more market-driven type of agreements.
Alejandro, thank you very much for all your insight there. It's been very interesting speaking to you.
Yeah, thanks very much. It's been my pleasure.
Thank you. Now that's all from Alejandro and myself for the moment, but the TV team will bring you press reviews, interviews and updates throughout the day, so please stay tuned. Bye for now.